Well, natural gas prices are up from the lows of below $2, and our next guest has his eye on even higher prices. Music to the ears, I'm sure, of a lot of people who've been waiting for natural gas prices to go higher. Joining us to give his outlook for the natural gas market and his top picks in the sector, Rob Lauzon. He's portfolio manager at Middlefield Capital. Nice to see you.
Yeah, good to be here.
A little while. I know, because we're out west now. So I said in the introduction here, you expect, and nat gas prices to be $5 to $6 by March of 2013. So we're talking, months now. Why?
Well, they're definitely unsustainable at these levels of below $3. The reason why they're here now is we didn't have a winter last year. So we entered the injection season this year with about 900 BCF, billion cubic feet of gas extra in storage. And that's why a lot of pundits were talking about gas going to zero. And the cure for low gas prices is low gas prices. So at these levels, it bounced off $1.90, but in the $2 to $3 range, it's more competitive to burn gas for electricity than coal. So we've seen about 5 billion cubic feet a day of increased consumption as you've had coal to gas switching. And when you do the math, 30 days in a month, so 180 BCF per month has been soaked up. So remember, I said we started the injection season with 900 BCF. So that's over 5 months, 5.5 months, you should actually soak up all that extra gas as long as the coal to gas switching occurs. So, we're kind of eyeballing mid-October, November 1st to be a more normalized inventory situation for natural gas. So that's the first step, to get gas back to about $4 in 2.5 months. And then through the winter, we think it'll move towards 5 and 6.
What if we have another winter like we had last time?
Then the forecast is thrown out and we're probably back to $2 to $3.
Okay, just want to be clear on what the parameters are here.
Yeah, so that's the major risk of the forecast is weather. We can't predict it. And I remember last year this time, some of these newsletter writers on, the experts in weather were forecasting a very cold winter. So even the experts can't predict the weather. And so what's also happened on the supply side, the companies aren't drilling for gas. There was 1,200 natural gas rigs drilling 18 months ago. There's less than 500 right now. And some of the large gas producers like Encana and Chesapeake have basically shifted CapEx towards oil. In their Q2 conference calls, they're now drilling for shale oil in the Eagle Ford and laying down their gas rigs. And they actually said, we're not going to spend a lot of CapEx on new gas projects until gas gets to 5. So there's also a hint of when hedging will come back in. But the supply, these shale gas wells that were drilled over the last 3 or 4 years have massive declines. So we're going to start to see the visibility of lower supply from that. Plus, like any company is going to drill your best wells first. So the last 4 years of this glut of shale gas, those are the best wells. They want to show how great the IP, the productivity rates are. The next 6 years will be the B-class wells, and they're not going to be as productive. So when gas does come back, it's going to be less productive wells. And that's why, we think it's both a consumption story to get us to 4 as we soak up the extra gas, and then it's a supply situation to kind of move us in that 5 to 6 range.
Now, the consumption story, though, is it not driven by the coal switching trend? So what happens when the coal switching trend switches back to,
so at 5 and 6, that'll go back to normal. But the lack of supply will be the factor of why gas will continue at 5 to 6. So there's two major types of thermal coal. You've got Powder River Basin coal, which the switching occurs around $3.50. And then you've got more in Pennsylvania, the Appalachian coal, which is around $4.50. So as gas gets, it's $2.80 today. As it goes to $3.50 next month, you'll have some coal to gas, gas back to coal switching. Right. And that $4.50 you'll have some more. And then we'll be back in a normalized inventory market. So the natural fundamentals will prevail. Overall consumption of natural gas doesn't really change. It's the economy's not rocking and rolling right now, so industrial use is kind of flat. So we'll go back to a normal market, but it's really the supply then, the lack of supply, the lack of drilling. If they're not drilling for 6 months and wells are declining at 30%, there's just that wedge that's forming down doesn't get filled back up. And you could actually have a shortage of gas come March, and it's very hard to believe right now. But if the stars are aligned, you could actually, I could give you a higher gas price, which I won't on the.
Well, I've only got 10 seconds, so let's finish it with a bang. Give me a high gas price in an extreme circumstance with all the stars aligned.
What's your marginal opportunity cost? It's importing LNG, which is trading at $12 in the world market. Wow. $14. So that's extreme, but
Gives you the
That's your if you're having a shortage of gas here, you got to import it like we did in '05 at $12.
Rob, great having you here.
Sure, thanks.
Rob Lauzon, he's portfolio manager at Middlefield Capital.